Man, it's cold in February, and so I just want some hope that it's going to get warmer in the future. And I think after February's market corrections, retesting January's lows, all of negative headlines of potential war and inflation, I think we just need a little hope and perspective.
This is Tyson Ray, financial advisor at Forum Wealth Advisors, where we exist to help make life better for our clients and those in our community.
This is up or down for February, and the market finished down after it went back to retest the lows we experienced back in January. This is the first back-to-back down months in the better part of 2 or 3 years. But back to some perspective. All of my clients ask me, what do I think? And what I want to tell them is I think a lot of things, but I think about a lot of what other people think. And one of the things we're able to finish in February is blending together several different firms, several different opinions of what does the future hold as far as rates of return go in the marketplaces. And so I want to share with you today what that looks like here at Forum Wealth. And so this is a capital market assumption for a 3 to 5 year time horizon into the future, pulled by several different firms. Specifically, in this case, it's a firm called BlackRock, a firm called State Street, and a firm called Invesco. And this is their expert opinion on what they think rates of return will look like going forward. And what I want to show you is for the next 3 to 5 years, and we've been saying this for a while because the research has been showing this for a while, for the next 3 to 5 years, you can't expect a whole lot of positive return in cash and in bonds because rising interest rates have a negative effect on bond prices. We don't expect interest rates to go up that much. And yet you see quite a dramatic difference in what the returns of the equity markets are going to be, which is a good reminder when you have a bad month that the future looks like there should be a positive return that's worth taking the risk or to tolerate the fluctuations of the market. Or where else are you going to go is another way of looking at it. And if you want another perspective, we can go out a little further. This is a 10 to 20 year time horizon. Again, the interest rate and the return on bonds comes back a little bit, but it is still quite a bit less than where the equity markets are. And so the way we're still allocated is to still overweight these markets because our opinion is, though Russia may be going to war here in Ukraine, that war, though it is a big deal, I don't think it's going to spark World War III on the backdrop of the fact that I don't think it's going to change how many people buy a new phone, how many miles Americans are going to drive as soon as we're free to move about this country, or the flights we're going to take, and all the economic activity that's coming back online. I think the market just got ahead of itself and it sold off in January. It rallied coming into February. It sold off again in February. And I think that tells me, at least historically speaking, it's probably going to rally again as the current news that's spooking investors and causing some people to take some money off the table turn into the April showers and May flowers that move us forward as humanity. And so I would give you some perspective. I think better days are ahead, and don't get too caught up on the February lows.
The purpose of these up or down videos is to try and bring a little understanding about what you should be doing with your long-term investments based on what is going on. And so this is Tyson Ray, financial advisor at Forum Wealth Advisors, where we exist to help make life better for our clients and those in our community.